Dear students, we will do module 82. Now 2-3 modules we have theoretical aspects. So this is talking about aggregation or clubbing of income. Now we have to understand what is aggregation. What is the need for clubbing of income? See, usually a SSC has to pay tax for only for the income he has earned. But in some situations people will try to avoid tax. If a person is getting less income within the family or friends or relatives or close circle, they will try to transfer asset or just the income without transferring the asset. That meaning they are just escaping the tax payment. So when income tax department will find this, they will consider this as the transferor's income. So there is a need for clubbing or aggregation of income when an SSC is asked to pay the tax for somebody else also, or that income what he is trying to escape will be added back to his income. So need for clubbing of income to prevent tax evasion. Second is curb tax avoidance through asset transfers. They will not transfer the asset, they will transfer only the income. Next is maintain progressive taxation. See, people in the higher income bracket, they are paying less tax. If they are transferring the income to a person getting income in the higher income, if they are transferring his income to a person earning lower income or taxed at a lower rate, maybe his spouse or children or anybody, then he can escape tax payment and everybody can get exemption from the tax laws. So that is not allowed. Progressive taxation, we have to be honest in paying our tax. Next is to ensure fairness in tax payment. Correct tax payment we have to pay to the government to prevent misuse of family relationships. Actually, they may not be transferring the asset or anything like that. They are just misusing the family relationship. So to avoid this, Income Tax Act has got a provision, aggregation or clubbing of income. So the general rule is normally a person will pay tax for their own income. But in the following cases, income of the spouse, minor child, son's wife or third party is included in the income of the individual. Now situation 1, when there is a transfer of income without transfer of asset. Say for example, if I am earning I am in the higher tax bracket. So what I can do, I can transfer if I have a house property to let out. I can, without transferring the house property, I can say that the income should be transferred to that person. That secret arrangement is that though it is paid to the other person transferring, the actual benefit will come to me. They will transfer it back to me. So that meaning I am getting the benefit, but in the eyes of the Income Tax Act, rent is going to some other person. So this is explained in section 60. Then the income is treated as the income of the transferor and not the transferee. Second is situation 2, when there is a revocable transfer of an asset. Revocable transfer meaning there is a condition that after certain conditions are fulfilled, the asset will come back to the transferor. Just to escape tax payment for a limited time, they are transferring the asset. This is explained under section 61. A revocable transfer is a transfer of an asset where the transfer retains the right to reassume, control or revoke the transfer, and therefore income is taxable in the hands of the transferor under the Income Tax Act 1961. Now situation 3, if the transfer is not revocable during the lifetime of the transferee, it is treated as irrecoverable. That meaning completely you are giving all the rights to the other person. Next is it remains the income of the transferee. So in this case there is no clubbing of income. The asset or the income from that asset will be considered as income of the transferee. This is explained under section 62. Now situation 4. Situation 4. Any salary, commission or remuneration received by spouse from a concern in which individual has substantial interest shall be included in the income of the individual. Say for example, if a company, husband and wife both are working, if both are equally qualified, everybody has got the right to earn salary, commission, interest, everything. Whereas if the spouse is not educated, just for tax payment, they are showing that a money paid or salary paid to spouse as an expenditure. It is not allowed. And when a person is having substantial interest is either a person is having 20% of equity rights with voting rights, then a person is having substantial interest. He can decide the rules for the company. But if the spouse or any family member is earning commission, salary or remuneration, they should be equally qualified or they should be competent to earn that income. Now, If the salary, commission or remuneration is earned by the spouse according to his or her qualification and expertise, it will be treated as his or her income. And a person is said to have substantial interest if he owns 20% or more shares in the concern. This is explained under section 64, subsection 1, 2. Now situation 5, if income from an asset is transferred to spouse without adequate consideration, it remains transferor's income. When the husband and wife relationship is existing, then itself they will transfer just to escape the tax payment. But the situation is, here the condition you have to remember, when you are transferring, the relationship of husband and wife should exist. But if their agreement is to live apart, or if it's in a divorce settlement, then it's possible to transfer asset to the spouse. So the transferring must not be an agreement to live apart. In case if income from such an asset is reinvested, the income from such reinvestment will not be clubbed. Then this is explained under section 65, subsection 1, 3. Now situation 6, if an asset is transferred to the son's wife without adequate consideration, income remains the transferor's income. This is income transferring to the daughter-in-law. This is explained under section 64, 1, 6. This is misuse of the family relationship. Now situation 7, if an asset is transferred to a third person but the benefit from such asset is still accruing to spouse, son's wife or minor child, income from such asset remains transferor's income. So if an asset is transferred to a third person, just a friend or a close relative or a trustworthy person, but the income, if you take the example of a building where they are getting the rent, so the income is coming to one of the family member, then also it will be considered as transferor's income. This is explained under section 64, subsection 1, 8. Now situation 8, this is the case of a minor child. This is explained under section 64, subsection 1a. Condition of clubbing the income of minor. This is an important question. You have to remember that. So every income of a minor child from whatsoever the source it may be will be added to the income of the parent whose income is higher. But another exception is there for this case, that is income of a minor child who is physically handicapped or a special child. That income will not be clubbed with the parent's income. Now the parent, whoever with the higher income, the minor's income will be added. But the parent can claim an exemption. So that is a parent in whose income of minor is clubbed can claim exemption of rupees 1500 per child or income so clubbed whichever is less. This is explained under section 1032. So the parent can claim an exemption of rupees 1500. Now one important point is there. This, if the parent of the minor is taxed as per the new tax regime, exemption under section 1032 is not available to such an individual. Now exemption of rupees 1500 deduction when clubbing the income of the minor will with the parent is not available as per the new tax regime. If it's old, then only the parent can claim an exemption of 1500. Now certain terms I want to explain. What is Binami transaction? A transaction where property is purchased in one person's name but the money is paid by another person who is the real owner. This was possible before before that black money and all. Now it is not possible to use that. Everything white money only we can make the payment. Demonetization. Before that it was possible to do these transactions, Binami transaction. The income arising from a Binami property is generally taxed in the hands of the real owner, that is the beneficial owner, whoever has paid money for that transaction under the Income Tax Act 1961. So Binami transaction, you have to remember. Now clubbing of negative income. See, we are talking about a person getting positive income for clubbing or aggregation of income. Negative income meaning if he is getting a loss, then also the same treatment. It will be treated with the income of the transferor. So clubbing of negative income means when a loss, that is negative income, arises to a person whose income is required to be clubbed, such loss is also included in the total income of the transferor. If the income of the specified person is clubbed, both profit and loss must be clubbed. So that is whether it is positive income or negative income, that is loss, it will be clubbed. Therefore, if there is loss, it will be added to or adjusted against the total income of the assessee. Such loss can be set off and carried forward according to normal provisions of the Act. So you have to remember, in the case of clubbing of income, whether it's profit or loss, it will be added to the transferor's income, and the remaining transactions carry forward and set off will continue as per the provisions. Now, what is the meaning of deemed income? Income which is not actually earned, but it is treated as income under specific provisions of the Income Tax Act 1961, and it's taxed accordingly. Now, deemed income, we have seen that. See, I am not having an asset, but I have an arrangement with somebody, with a family member, that they have a property, but that income, rental income should come to me. It's a deemed income for me. So, income tax treatment of deemed income. Deemed income is taxed in the year in which it is discovered or deemed to arise. No deduction or allowance is permitted against such income. Such income is generally taxed at a special higher rate under section 115 BBE without allowing set off of losses. Now, the list of deemed incomes, I'll tell you. Cash credits. You're getting an unusual cash credit in your bank account. This is usually possible with the smuggling, selling of drugs and all. Unexplained investments. You made an investment, but where you got the money, you are not able to explain to the income tax department. Unexplained investments. You made investments, but you're not able to give the source of income. Account of investments not fully disclosed in the books of accounts. That investment or that money, whatever you have invested or you have spent, is not able to show it in the books of accounts. Unexplained expenditure, lavish weddings, lavish family get togethers, lavish travel holidays, or anything like that, there you are answerable for that. Payment of hundi money in cash. See, hundi money is that dump box, church, temples, and all will collect. So that during the Lenten season and all, so they will collect that money. So that if you are getting unusual income from that, you are answerable. We have to give the source for that, how you collected all that. So this is what I wanted to explain in this module. Happy learning. Thank you.